Imagine walking into a Dollar Tree. You know, you navigate past the seasonal greeting cards, you turn down the aisle, and you end up spending $12 on a heavy-duty hammer, a bottle of Frank's Red Hot sauce, and a name-brand box of Rice-A-Roni.
Right, and the giant green sign on the building still literally says dollar.
Exactly. But inside that box, the entire DNA of a retail giant is being fundamentally rewritten in real time. I mean, for decades, Dollar Tree wasn't just a brand name, it was an ironclad contract.
Oh, totally. You walk in with a single Washington and you walk out with the item in your hand.
Yeah, it was the absolute definition of pricing purity. But today, we are looking at a company that is willingly breaking its own fundamental rules just to survive 2026.
It is a massive identity crisis. But, you know, what is so compelling is how highly calculated that crisis actually is.
Right.
I mean, you don't abandon a 40-year pricing model on a whim. They're doing this because the macroeconomic environment is forcing their hand. But they're executing the pivot with this incredible level of precision.
And that is exactly what we are unpacking today on the Deep Dive. Welcome in, everybody. Today, we are looking directly at the Q1 fiscal 2026 earnings call for Dollar Tree.
Yeah, we've got the transcripts, the management commentary, the financial breakdowns.
Right, and our mission today is to figure out how Dollar Tree is navigating intense inflation, shattering that sacred $1 barrier, and executing a massive physical overhaul of their stores.
And the craziest part of all of this, they are somehow capturing a brand new demographic of higher income shoppers while they do it.
Which completely defies traditional retail logic, doesn't it?
Oh, absolutely. Usually when a discount brand raises prices, they just alienate their core base.
Yeah.
And they fail to attract anyone new.
Yeah, they end up in this weird middle ground where nobody wants to shop there.
Exactly. But when you listen to the management team on this call, specifically the CEO and the CFO laying out the quarter, you realize their model is somehow built to thrive in this exact kind of macroeconomic pressure cooker.
So let's start with the hard reality of the numbers. Because I'm looking at their Q1 performance and I keep having to double check my notes.
The numbers were pretty staggering.
Yeah. Net sales jumped 7.2% to $5 billion.
$5 billion.
$5 billion in a single 3-month window. I mean, for a store where the vast majority of items still cost literal pocket change, the sheer velocity of items moving through cash registers to hit $5 billion it's almost hard to wrap your head around.
It requires a staggering logistical footprint, frankly. But, you know, what Wall Street really cared about was how much of that $5 billion actually made it to the bottom line.
Right, the profitability.
Yeah. Their adjusted earnings per share, which is the profit allocated to each outstanding share of stock, skyrocketed by 38% year over year. It hit $1.74.
$1.74. And just to put that in context for you guys listening, that didn't just beat analyst expectations. That beat the absolute high end of the company's own internal guidance.
They completely blew past their own best case scenario.
Yeah, they really did. And looking at the profitability metrics, their gross margin expanded by 120 basis points.
Right. And, you know, in the retail space, we talk in basis points to measure tiny fractions. So 100 basis points equals 1%.
Okay, so 120 basis point expansion means their gross margin grew by 1.2%.
Exactly. Now, if you're looking at high-end software, 1.2% is basically a rounding error, but in deep discount retail,
where your entire business model is based on capturing literal pennies of margin per item.
Exactly. Expanding your profitability by over a full percentage point is a monumental operational victory.
Wow.
It means the core engine of the business is running significantly hotter and just much more efficiently than it was a year ago.
But the engine is running differently, and this is where I started scratching my head while reading the transcript.
Uh-oh. What caught your eye?
Well, when we look at their comparable store sales, which is a golden metric because it strips out the revenue from brand new stores and just looks at locations that have been open for at least a year.
Right, the comps.
Yeah, the comps. Those sales rose 3.5%, a really solid number. But the composition of that 3.5% is full of friction.
Yeah, it's very lopsided.
Completely lopsided.
Yeah.
It was driven entirely by a 4.5% increase in average ticket, meaning people are spending more money every time they check out.
Right.
But foot traffic, the sheer number of human beings walking through the front door, actually went down by 1%.
It is the ultimate teeter-totter effect in retail.
Exactly. It feels like running a restaurant where fewer people are walking in off the street. But the ones who do sit down are suddenly ordering 3-course meals and top-shelf margaritas instead of just grabbing a side salad and water.
That is a great analogy.
I mean, I have to look at that and wonder, Is that sustainable? If fewer and fewer people are showing up to the party, doesn't the music eventually have to stop, no matter how much the remaining guests are spending?
It's a completely valid concern, and honestly, if that foot traffic decline was a permanent, accelerating trend, it would be a massive red flag. For any investor holding the stock, you'd be sweating.
Yeah, you'd be hitting the sell button.
Right. But management's interpretation of this data is very different. You really have to look at the sequence of events over a longer timeline here.
Okay, how so?
Well, when a brand like Dollar Tree fundamentally changes its pricing, when you break the buck and introduce items that cost $3, $4, or $5, there is an inevitable psychological shock to the consumer.
Right, the customer walks in, sees a $5 price tag, and thinks, wait, am I in the right store? I thought this was Dollar Tree.
Exactly. There's a natural recoil. People walk out.
So they expected the traffic drop.
Completely. Management views this 1% traffic drop not as a structural failure of the business, but as a temporary muted reaction to those recent pricing resets across the store.
Okay, but is there actual data to back up that optimism?
There is. Here is the critical piece of data that proves their point. That 1% decline actually represents a measurable improvement from the previous quarter.
Oh, wow.
Yeah. If we zoom out and look at the trend over a 24-month period, to smooth out the noise of seasonal spikes, the traffic trend line actually improved significantly in the first quarter compared to the end of last year.
Oh, I see. So the bleeding is actually slowing down.
Exactly.
Hit the bottom of the traffic dip, and now it's curving back up as consumers get used to the new reality.
You nailed it. Management expects the foot traffic to normalize much faster this time around because this specific round of price increases was highly targeted.
Right.
They weren't just uniformly raising the price of every single cheap item in the store. They were strategically introducing completely new, higher quality items into the assortment.
Which takes us right into the most controversial shift in this company's history.
Yeah.
The reason that average ticket size is growing is because of what they're calling their multi-price evolution.
Such a corporate buzzword.
Oh, totally.
Right.
But practically, they're actively trying to train the consumer to stop thinking of them as just a destination for loose change. And the examples the CEO gave on the earnings call were incredibly tangible. They introduced a $5 hammer.
Yeah, and not a flimsy one.
Exactly. Not a flimsy single-use toy hammer, but a legitimate heavy-duty piece of hardware. Plus, they've hiked prices in the center store food section up to $1.50.
And we really have to examine why they did that because, the cynical view is that it's just corporate greed trying to squeeze an extra 50 cents out of a struggling consumer.
Right. Inflation as an excuse.
Exactly. But the reality is that the rigid $1 price point had actually become a cage for them.
A cage? How do you mean?
Well, over the last 5 years, due to raw material inflation, transportation costs, labor Dollar Tree literally could not afford to buy and stock recognized name brand food items at a price that allowed them to sell it for $1 or even $1.25.
Oh, the math just broke.
The math completely broke.
So they were forced to stock generic substitutes, the O-shaped toasted oat cereal instead of actual Cheerios.
Right. And while the core customer will accept generic substitutes for some things, like maybe you don't care about the brand of your paper plates, there are certain categories where brand loyalty is just ironclad.
Yeah, you mess with someone's favorite hot sauce, and there's going to be a problem.
Exactly. By allowing that price ceiling to drift up to $1.50, they suddenly unlock the ability to source the brands people actually want.
So that's why they specifically called out bringing back Spam, Rice-A-Roni, and Frank's Red Hot sauce on the call.
Yeah, the CEO even made a joke about putting Frank's Red Hot on everything.
I heard that. But, the strategy underneath the joke is vital. They instantly improve the relevance of their store to the everyday shopper.
Absolutely. You don't have to make a separate trip to a massive grocery store just to get the name brand hot sauce anymore. You can get it right there.
And that feeds perfectly into this internal merchandising mantra they kept repeating on the call, which I find brilliant. They are telling their teams, come for the holiday, stay for the everyday.
It perfectly encapsulates the pivot. I mean, historically, what is Dollar Tree famous for?
The cheap seasonal decor.
Yeah, it's the undisputed king of cheap seasonal decor and party supplies.
Right, you go there for the graduation balloons, the cheap plastic Halloween skeletons, or, a massive bag of fake Easter grass. It's a highly specific destination trip for a singular event. You go in, you buy the party stuff, and you leave.
Exactly. And that is a great business, don't get me wrong, but it's incredibly spiky.
Meaning revenue just surges and then dies down.
Right. What they are trying to do with this multi-price strategy is convert that occasional seasonal shopper into a regular, everyday household consumer.
Oh, they want you there every week.
Yes. They want you to walk in because you need cheap Mother's Day cards. But while you are navigating the aisles to find the cards, you suddenly see a solid $5 hammer.
Or you see the exact brand of shampoo you use for $4.
Right. Or you remember you need rice-a-roni for dinner and grab it for $1.50.
Yeah.
They are actively trying to build out the everyday categories: toys, beverages, personal care, hardware.
So that Dollar Tree becomes part of your weekly routine, not just a place you visit before a holiday party.
Exactly.
Okay, I understand the corporate logic. I really do. But I have to push back here on behalf of the actual shopper and on behalf of any investor trying to figure out if this is actually actionable.
Go for it.
The entire brand equity of Dollar Tree is built on absolute blind trust. If I walk in expecting everything to be ultra cheap and I suddenly start seeing $5 hardware items or $4 personal care items, aren't you going to induce massive sticker shock?
Yes, that's the risk.
Because at a certain point, if my basket is filling up with $5 items, why wouldn't I just drive the extra 2 miles to a massive big box merchant like Walmart or Target? The selection is infinitely larger, the aisles are wider, and I can get literally everything else I need.
That is the existential risk of this entire strategy. You hit the nail on the head. If they lose that perception of value, the whole house of cards collapses.
So how are they preventing that?
Well, the data management provided paints a very reassuring picture of how they are balancing this. Even with the introduction of all these new $3, $4, and $5 multi-price items, 85% of the store's total sales mix remains at $2 or below.
Wait, 85%?
85%.
So despite all the headlines about the $5 hammer, the vast, vast majority of what is actually moving through the checkout lane is still essentially pocket change.
Yes. The opening price point remains the absolute anchor for the brand. In fact, if you aggregate every single item sold across the entire company, the average unit price is still only $1.51.
$1.51, wow.
Yeah. So to address your point about sticker shock and fleeing to a big box retailer when a customer checks out at Dollar Tree, their average total basket size is just over $12.
Ah, okay, that frames it completely differently.
Exactly. The psychological threshold is totally different. If your entire grocery, hardware, and seasonal run costs $12, you are not experiencing that deep, visceral financial panic that hits you when you check out at a mass merchant and the screen suddenly reads $165.
Yeah, that screen at Target can ruin your whole day.
The stakes are just so much lower at Dollar Tree.
Okay, 85% is under $2 right now. But let me challenge that. Once a corporation breaks the psychological seal of a fixed price point, doesn't margin chasing usually take over?
It's a slippery slope, definitely.
Right? What's stopping that 15% of high-price items from creeping up to 30% or 40% over the next 2 years? How do they guarantee they don't just become a slightly shabbier, smaller version of Target?
That's where their internal benchmarking process comes in. And honestly, it's rigorously mathematical. They don't just throw a $5 price tag on a hammer or a $1.50 tag on rice-a-roni and just cross their fingers and hope it sells.
Okay, what do?
Their merchants have strict comparative models. Now, they will actually allow competitors to use much larger pack sizes in these comparison models.
Wait, explain how that works, because usually buying in bulk makes the item cheaper.
Exactly. If Walmart sells a massive 32-ounce family-size box of a product, their per-ounce cost is naturally going to be lower due to economies of scale.
Right, that's the whole point of Costco and Sam's Club.
Yeah. But Dollar Tree merchants are tasked with ensuring that even when compared against those massive bulk sizes from competitors, the Dollar Tree item still wins on a strict per ounce or per unit value basis.
Oh, wow.
Yeah, they guarantee that even at $1.50, their 8-ounce box is mathematically the absolute cheapest option in the market for that specific quality of item.
So the value proposition remains entirely intact. It's just being applied to slightly higher tier goods.
Exactly. They are basically saying, we will raise the price ceiling, but we absolutely refuse to lose on the per ounce math.
That makes a ton of sense. But with the basket price slightly increasing and, the macroeconomy doing what it's doing, we really need to look at the people actually holding those baskets.
We really do.
Who is shopping at Dollar Tree right now. Because the consumer reality they described on the call was, frankly, pretty brutal for a large segment of the country.
It was a very sobering part of the presentation. They were highly transparent about the immense compounding pressure their core low-income consumer is facing.
Yeah, the inflation compounding year over year.
Right. We are talking about a demographic that has endured multi-year stacked inflation on the absolute non-negotiables of life. I mean, you can delay buying a new television, but you cannot delay paying your rent.
Or your heating bill, or buying groceries.
Exactly. Yeah. Those costs have soared. And recently, they've been hit with a significant spike in fuel prices.
Well, fuel is the silent killer for retail. When gas prices go up 20 cents a gallon, the Dollar Tree core customer feels it instantly. It doesn't just make the drive to the store more expensive. It eats directly into their highly constrained weekly disposable income. There is literally less cash left in the envelope at the end of the week.
Right.
And yet, this is where the earnings call delivered a major plot twist, because despite this immense squeezing pressure on the low-income shopper, Dollar Tree reported positive comparable store growth across every single income cohort.
Every single one. Which is the magic of the discount model during tough economic times. It introduces a massive wave of what the industry calls trading in.
Trading in. Okay, I'm looking at these numbers, and it seems like affluent shoppers are actually abandoning traditional grocery stores and migrating to Dollar Tree to hide from inflation. Is that what trading in means here?
That is exactly what it means. Trading in or trading down, depending on your perspective, is when middle and higher income consumers who are also feeling the pinch of a high interest rate, inflationary environment, start migrating away from their usual, more expensive grocery stores or specialty retailers.
They need a break too.
Right. They start going to discount stores to stretch their dollars on everyday consumables. Dollar Tree noted a staggering statistic on the call. More than half of their newly acquired households over the past year actually skew toward higher income brackets.
Over half. The affluent shoppers are literally driving the growth of a dollar store.
It's pretty wild to think about.
And honestly, looking at the psychology of it makes total sense. I call it the guilt-free treat-yourself phenomenon.
Oh, I like that.
Think about it. When the macroeconomy feels terrifying, when your mortgage rate is locked in high, when a regular trip to the grocery store costs $200, you still have a human desire to experience the dopamine hit of buying something.
You still want to shop.
You want to shop.
Yeah.
But doing a $50 impulse run for a candle and some mugs at a larger specialty retailer induces immediate financial anxiety.
Oh, definitely.
Dropping $5 on a piece of seasonal home decor or a new coffee mug at Dollar Tree, that provides a safe psychological thrill. You get to shop, you get to discover new items, but there's absolutely zero financial hangover the next morning.
That is a perfect articulation of the dynamic. In fact, the CEO literally used the exact phrase, guilt-free treat yourself on the call, to describe this behavior.
No way, really?
Yeah.
Yeah.
Because the average item is $1.51, the cost of discovery is incredibly cheap. And that fundamental value proposition resonates across the entire economic spectrum. Whether you make $30,000 a year and are shopping for survival, or you make $130,000 a year and are looking for a cheap thrill.
That is fascinating. But we can't ignore how tightly wound and stressed the core consumer base still is. And nothing illustrated the reality of living paycheck to paycheck better than the massive Easter headwind they faced in Q1.
Yeah, this was a fascinating dive into operational mechanics and consumer timing.
Laid out for us.
So, this year, the Easter holiday shifted earlier into the calendar. It moved into a colder weather month, which is historically tough for spring seasonal sales. And crucially, it had 2 fewer selling weeks leading up to it compared to the previous year.
Now, on paper, that doesn't sound like a catastrophic issue. Easter happens every year.
Right. You'd think people just adjust.
But management pointed out that their core customer is currently shopping close to need.
Yes.
Meaning, if cash is tight, you aren't buying chocolate bunnies and plastic eggs 3 weeks in advance. That money is needed for dinner tonight. You are waiting until the absolute last minute to buy the discretionary holiday items.
Exactly. And because they lost those 2 weeks of buffer time and the weather was poor, it caused a massive dent in the early seasonal buildup. It was a natural, calendar-driven headwind that completely disrupted their normal seasonal sales curve. They were tracking significantly behind where they should have been.
But then this is the part that shows how vital this store is to its customers. They still managed to deliver record-breaking sales in the final days leading up to the holiday.
Incredible surge at the end.
The customers still showed up.
Yeah.
They just waited until the literal 11th hour, likely waiting for a specific payday to hit. It shows you exactly how much they rely on Dollar Tree to provide those moments of joy for their families, but also how painfully constrained their cash flow is.
It is a profound testament to the resilience of the demand. The demand for the holiday didn't vanish because of inflation. It just compressed into a very short, highly intense window.
Which has to be a nightmare for the stores.
Oh, from an operational standpoint. The supply chain and the store managers had to be prepared to handle that massive, last-minute influx of traffic and inventory movement without the system breaking down.
Okay, so let's track the logic so far. The top-line pricing strategy is clearly working.
Yes.
The multi-price items are selling, moving the average ticket up. Higher-income shoppers are arriving in droves to trade in and find deals, while the core customer is still relying on them for last-minute essentials.
That's the revenue picture, yeah.
But what actually happens when these brand new high-income shoppers walk inside the physical store? Because, let's be honest, historically, Dollar Tree hasn't exactly been known for having pristine, wide, easily navigable aisles.
That's putting it mildly.
Right. In the past, going into some locations felt like a treasure hunt through a mildly chaotic, poorly lit warehouse.
Which connects directly to one of the most vital structural transformations happening at the company right now. It's not just about what they sell. It's about the radical physical overhaul of the stores themselves. This physical cleanup is driving significant operational efficiencies and financial returns.
Yes. Let's get into this operational cleanup because the mechanics here are fascinating. We mentioned at the very beginning of the deep dive that gross margin expanded by an impressive 120 basis points.
Right.
That wasn't just magic or the result of charging an extra 50 cents for hot sauce. A massive driver of that margin expansion was a reduction in shrink.
Shrink. Shrink is the retail industry's catch-all term for lost inventory.
Meaning theft, right?
It primarily refers to theft, whether that's external shoplifting or internal employee theft. But it also includes items that are damaged in transit, expired, or lost due to administrative scanning errors.
Okay.
Over the past few years, shrink has become an existential crisis for the entire retail sector. You read headlines constantly about major retailers locking up entire aisles behind plexiglass just to stop the bleeding.
Yeah, going to the drugstore right now feels like visiting a bank vault.
Exactly. But Dollar Tree is actually bending the curve and bringing shrink down.
But how are they actually doing it? Because the CEO mentioned some very specific aggressive tactics, but they didn't involve turning the store into a fortress.
Right.
They've implemented what they call non-negotiable audits. They're doing continuous teaching and coaching with store managers, and they've deployed specific product protection protocols for high-risk items.
What's fascinating about their approach is the nuance. They realize that if you just lock everything behind glass, you destroy the guilt-free, treat-yourself impulse buying that drives their margins.
Yeah, nobody impulse buys something. They have to press a button and wait 5 minutes for an employee to unlock.
Exactly. Instead, they are aggressively tightening their basic merchandising standards.
Meaning what exactly? Just keeping the shelves neater.
It's deeper than that. It's about product placement and oversight. If a specific brand of razor or a certain cosmetic item is statistically high risk for theft, they don't necessarily lock it up. They might move it to an end cap directly in the line of sight of the checkout counter.
Oh, that makes sense.
Yeah, they apply deliberate inventory controls and stronger management oversight in those specific departments. And the early data is proving that these highly targeted, disciplined, localized executions are measurably bringing their inventory losses down without ruining the shopping experience.
But the shrink reduction feels like a symptom of a much larger cure. It all circles back to their internal Gold Store initiative.
Oh, this was a huge part of the call.
Yeah, and this is where the transparency from the management team got almost shocking. They openly admitted that previously, a staggering 42% of all Dollar Tree stores were operating below the company's own internal standards for cleanliness and organization.
To put that 42% number in context, most major healthy retailers are usually dealing with a problematic tail of maybe 15 to 20% of underperforming or messy stores.
Right.
Having nearly half of your entire fleet operating below your own standard is a systemic cultural issue. Internally, the management team referred to this challenge as the Himalayas.
The Himalayas.
Yeah, because if you charted their store performance, it looked like a massive, jagged mountain range of operational problems.
The Himalayas of bad stores. I love that. But through this Gold Store initiative, they have aggressively wrestled that number down to under a third of the fleet.
Which is huge progress.
And the CEO used this incredibly relatable analogy on the call to explain the momentum of this turnaround. He said, imagine you have to clean a house that is completely trashed. If every single room is a total disaster, it is completely overwhelming. You literally don't know where to start.
It's paralyzing for the operators on the ground.
Exactly. But you pick one room and you clean it. And then you clean the next. As you clean it room by room, maintaining the rooms you've already cleaned gets much easier.
Yeah, because you're building a habit.
Right. And because there are fewer disasters left to fix, the pace of the cleanup actually accelerates. The effort isn't linear. It gains exponential momentum. As more and more stores hit that pristine gold standard, the regional managers and corporate teams can take all the energy they used to spend putting out fires everywhere and focus it intensely on a much smaller pool of problem stores.
And if we look at the underlying mechanics of retail, a clean store isn't just about aesthetics or making the customer feel good. It is a literal financial engine.
How so?
The CEO explicitly stated the mechanism shrink improves in well-run stores. Why? Because when a store is clean, brightly lit, and highly organized, it is immediately obvious to a manager when something is out of place or missing.
Oh, that's so true.
It deters casual theft because there are no messy, unmonitored corners to hide in. It's drastically easier to manage in-stock levels, meaning you don't accidentally reorder 50 boxes of something you already have buried in the back room.
And we can see the literal mathematical proof of this operational cleanup in their inventory metrics. This is a stat that made me do a double take.
Let's hear it.
Total inventory across the entire company dropped by 9% year over year, while their sales simultaneously rose by 7.2%.
That right there is the holy grail of retail supply chain operations.
You are selling significantly more goods to the customer, but you are holding significantly less stock in your backrooms and distribution centers to do it.
Yep.
Wait, explain how they actually achieve that, because it sounds like magic. If you're selling 7% more stuff, shouldn't you naturally need 7% more stuff sitting in the warehouse?
And a clunky system, yes. But they achieve this by fundamentally changing how inventory flows. Historically, if a retailer was inefficient, they would carry massive amounts of safety stock. Yeah, extra pallets of goods just sitting in distribution centers because they couldn't trust their own logistics network to deliver items just in time. What Dollar Tree has done is unclog their distribution centers. They are moving goods faster from the port to the warehouse, to the truck, to the shelf. They increase their inventory turns, which is the speed at which an item is bought by the store and then sold to a customer.
And the financial impact of that speed is massive. The CFO pointed out that if their inventory had merely grown in line with their 7.2% sales growth over the past 12 months, Dollar Tree would have been stuck holding $425 million in excess inventory.
Just think about the physical reality of that.
Yeah, nearly $500 million of random, bulky merchandise just sitting there, clogging up the distribution centers, spilling into the store aisles, degrading in quality, and completely destroying their working capital.
Instead, by focusing on velocity and unclogging the system, they generated what we call a favorable inventory to sales spread. The immediate benefits are obvious. The assortment on the shelves feels fresher to the customer. The physical stores are vastly easier to navigate for employees, and the company is sitting on a much, much healthier balance sheet. They actually ended the quarter with $1 billion in cash, largely because they didn't have $500 million tied up in stagnant boxes of seasonal plastic.
Okay, so let's synthesize where we are. The top-line pricing strategy is working, driving up the average ticket.
Yep.
High-income shoppers are migrating in. They are walking into stores that are drastically cleaner, with better, faster-moving inventory and declining theft.
It's a great story so far.
But here's a hurdle. If you are fundamentally improving the physical stores and you are stocking beloved name brands like Spam and Solid Hardware tools, you actually have to tell people about it, right?
Obviously.
Because if a suburban mom gave up on Dollar Tree 5 years ago because the stores were messy and the products were generic, she isn't just going to magically wander back in today to check if things have improved.
Exactly. You cannot rely on passive foot traffic if you want to aggressively alter consumer perception on a national scale. And that reality explains how Dollar Tree is shifting its capital allocation behind the scenes to fuel this next phase of growth.
The CEO used a very specific phrase for this. He called their marketing department a new muscle.
A new muscle, yeah.
Because historically, Dollar Tree didn't really need a highly sophisticated marketing engine. They relied almost entirely on massive unaided brand awareness. Everyone in America knows what a Dollar Tree is.
Right. You drive past the strip mall, you see the bright green sign, and you instantly know what is inside the box.
But as we spent the last half hour discussing, what is inside that box is fundamentally changing.
It's completely different.
The average consumer driving past that sign doesn't inherently know there's a high-quality $5 hammer or a $1.50 bottle of Frank's Red Hot waiting for them. The old perception is actually a barrier now.
So they have to actively re-educate the market.
And they are just taking out full-page newspaper ads or buying incredibly expensive, broad Super Bowl commercials. They are building a modern marketing apparatus. They are heavily investing in targeted, data-driven, AI-leveraged social media engagement.
AI marketing for a dollar store. Think about that.
Right. They are getting incredibly granular with how they communicate their new value proposition to vastly different customer segments.
It represents a major philosophical shift from passive retailing, just opening the doors and waiting for people to active customer acquisition.
But how does a discount retailer actually use AI?
They use it to analyze purchasing patterns and build highly specific audience profiles. If the data shows a high-income shopper is indexing heavily on seasonal decor, the AI can help target that specific household with social media ads highlighting the new premium $5 home goods.
Oh, wow.
Meanwhile, a different profile might receive ads highlighting the $1.50 name brand groceries. They are tailoring the messaging to highlight key categories, support seasonal events, and promote the multi-price items.
But building a brand new, data-driven, AI-powered marketing arm from scratch is not cheap.
No, it's very expensive.
You have to hire data scientists, you have to buy ad inventory, which leads us to look at their SG&A expenses. For the uninitiated, SG&A stands for Selling, General, and Administrative Expenses. Basically, the broad operational costs of running the corporate machine that aren't directly tied to manufacturing the products they sell.
And this is where their internal cost discipline really shined in the quarter.
Oh, yeah.
Even though they absorbed the heavy upfront costs of flexing this new marketing muscle, and they absorbed rising general liability costs, which is an industry-wide headache involving expensive insurance premiums and legal claims.
Right.
Their total operating costs essentially didn't budge relative to their massive sales growth. Their SG&A ticked up by a microscopic fraction of a percent.
Which means they funded this massive marketing evolution essentially out of their own operational efficiencies. And there's a really interesting structural shift happening in their corporate overhead that explains how they found those efficiencies.
The Family Dollar news.
Yes, they announced they're completely eliminating the Family Dollar corporate segment.
Right. Dollar Tree owns the Family Dollar banner, but following a strategic review and an ongoing process to potentially sell or spin off Family Dollar, management realized they no longer need a massive duplicated corporate structure to support it.
Why have two HR departments when you can have one?
Exactly. They're streamlining the entire organization down to one single unified corporate architecture by the first quarter of 2027. It's a massive simplification of how the company is run, and the financial impact is already visible. In the first quarter alone, corporate SG&A actually declined 15% year over year.
So the corporate suite is getting vastly leaner, the physical stores are getting significantly cleaner, and the marketing is getting incredibly smarter.
It's quite the trifecta.
But there is an invisible foundational cost to retail that we have to dig into. The literal physical reality of getting a bulky $1.50 box of rice-a-roni from a manufacturing facility across the country or across the ocean onto a specific shelf in Ohio.
Yeah, logistics.
With global inflation and geopolitical instability, how are they handling the massive logistical cost of freight?
Freight is always the great wild card in discount retail. When you are shipping cheap, bulky items, the cost of transportation is incredibly margin sensitive.
Makes sense.
If it costs you $5 to ship a $1,000 laptop, you don't care. If it costs you $5 to ship a box of plastic cups that retail for $1.50, your profit margin evaporates instantly.
Oof, go on.
The CFO laid out the current freight landscape very clearly, and it's a mixed bag. On the positive side, base freight rates, the standard cost to move a container, remain quite favorable right now because domestic and ocean shipping capacity is readily available.
And they've made a really smart strategic pivot in how they negotiate those shipping costs, right? They've shifted their freight agreements to much shorter term contracts.
Exactly. And the mechanism here is crucial to understand. Usually a massive retailer might lock in a 3-year contract with a logistics provider to guarantee their pricing and secure their supply chain.
Which seems smart for predictability.
Normally, yes. But in the current global environment, spot market prices, which are the immediate, daily, real-time rates for shipping a container if you don't have a contract, are incredibly high and volatile.
Okay.
By shifting to short-term contracts, typically around a year long, Dollar Tree stays tightly coupled with the current market reality. They avoid paying those astronomical daily spot rates, but they also retain the flexibility to quickly renegotiate lower rates if the overall global shipping market cools down next year.
That's really clever. But it's not all smooth sailing. The CFO explicitly called out two major tightening pressures on their supply chain.
Right.
First, driver availability is starting to squeeze. There's a shortage of people willing to drive long-haul trucks, which naturally drives up labor costs on the domestic trucking side. And second, and far more impactfully, fuel surcharges are rising rapidly.
And this is where macroeconomics crash directly into discount retail. Rising fuel surcharges are a direct, unavoidable consequence of the prolonged geopolitical conflict in the Middle East. When tensions in that region disrupt or threaten global oil supplies, the price of diesel fuel spikes globally. Suddenly, every single truck delivering a pallet of goods to a Dollar Tree store costs significantly more to operate. And the freight companies don't just absorb that loss, they pass those fuel surcharges directly onto the retailer line by line.
Which means Dollar Tree is paying more to move every single item, which is the perfect transition into looking forward. We've dissected the quarter that just ended. We've looked at the changing consumer, the cleaner stores, the new marketing, and the supply chain pressures.
Time to look at the future.
Now it's time to examine where management is steering this massive ship for the rest of fiscal 2026. Let's look at the actual financial guidance they provided to Wall Street.
Management raised their full-year outlook based on the massive strength of their Q1 performance. They are now projecting full-year net sales to land somewhere in the range of $20.5 billion to $20.7 billion.
Nearly $21 billion in sales. The scale is just staggering.
It really is. They expect comparable store sales growth to remain steady in the 3% to 4% range for the year. And they raised their adjusted EPS guidance, their profitability metric, to a range of $6.70 to $7.10 per share.
Nice.
For the immediate future, their Q2 outlook projects sales of $4.8 billion to $4.9 billion, with an EPS of $1 to $1.15.
While we are talking about EPS, we absolutely have to mention how aggressively they are treating their shareholders, because if you hold the stock, this is huge.
Oh, buybacks.
Yeah. Over the past 12 months, Dollar Tree has returned a staggering $1.7 billion to shareholders via stock buybacks. They repurchased 5.5 million shares just in Q1 for $595 million. That is a massive capital allocation strategy that actually reduced their total outstanding share count by roughly 8%.
And we should explain the financial engineering behind that because it directly impacts that EPS guidance you just mentioned.
Please do.
When a company uses its cash to buy its own stock off the open market and retire those shares, it mathematically boosts the earnings per share going forward. Why? Because the overall profit of the company is now being divided among 8% fewer shares.
Every remaining slice of the pie is inherently larger.
Exactly. It's a massive, tangible vote of confidence from the management team in the underlying value and future cash flow of their own business.
But here's where the analytical rubber meets the road.
Yeah.
And where I think the management team is playing a really fascinating game of chess. They had a massive blowout Q1. They beat Wall Street's expectations handily.
Right.
But they didn't pass all of that Q1 upside into their full-year forecast. They raised the guidance, yes, but not by the full magnitude of the Q1 beat. Wait, so they crushed Q1, but they're holding back on their full-year forecast.
That's right.
That's incredibly paranoid. That's like packing a heavy parka and a giant umbrella for a trip to the Bahamas just in case the weather app is lying. Why hold back?
Because they are baking in some extremely harsh, pragmatic macroeconomic realities. They aren't assuming the sunny weather will last. They are looking at the geopolitical landscape we just discussed, and they are making the conservative, safe assumption that these higher fuel prices and elevated transportation costs are going to last significantly longer than anyone originally anticipated.
I see.
They are proactively planning to absorb those higher costs into their margins in the back half of the year, rather than hoping the conflict magically resolves and the costs disappear.
So they are taking the financial windfall, the extra cash they generated by overperforming in Q1, and they're essentially using it as a buffer to insulate the company against potential macroeconomic storms in Q3 and Q4.
Precisely. And the biggest storm cloud on the horizon beyond fuel is tariffs.
Right.
For a company like Dollar Tree that imports a vast, vast amount of goods from overseas to maintain its low price points, tariffs are a massive, highly volatile variable.
Let's unpack the mechanics of this tariff situation because it's legally complex but financially crucial to understanding their conservatism.
Management is taking a very prudent, almost defensive approach here. Currently, Dollar Tree is enjoying slightly lower tariff rates on their imported goods due to a specific recent legal environment and ongoing litigation.
Okay.
However, management is building their financial models under the strict assumption that these lower rates will only last through July. After that, they are budgeting for tariffs to aggressively revert back to the much higher levels that existed prior to a February 20th Supreme Court decision.
So they are actively planning for the worst-case regulatory and legal scenario. They are assuming their import costs will spike in August.
Yes.
But that also means there are major potential upsides that are completely left out of their conservative guidance. If the macro environment breaks their way, this company could absolutely soar past these estimates.
Exactly. The CFO explicitly outlined 3 major upside scenarios that are emphatically not baked into the current numbers.
What are they?
First, if the Middle East conflict resolves, stabilizing the region and dropping global oil prices before year-end, that provides immediate, unforecasted margin relief on their freight costs.
That would be huge.
Second, if the current lower tariff rates somehow get legally extended past July, that represents a massive, unexpected cost savings on millions of imported items.
And the third upside is the wild card, to end all wild cards tariff refunds.
Yes.
Because of the complex, ongoing legal challenges regarding how certain tariffs were applied historically, Dollar Tree is participating in a government refund program. They could potentially receive a massive lump sum influx of cash from the government, reconciling past overpayments.
And what is vital for any investor or analyst to know is what management plans to do with that potential windfall.
Buy more stock.
No, actually. They stated explicitly on the call that they do not plan to just hoard the tariff refunds on the balance sheet or drop them entirely to the bottom line to artificially pad their quarterly earnings and trigger executive bonuses. They intend to reinvest those refunds directly back into the business, pouring that cash into widening their price competitiveness, accelerating the Gold Store cleanup standards, and funding that new AI marketing muscle to spin their growth flywheel even faster.
That is exactly what you want to hear if you are looking at the long-term health of a company. You use the unexpected windfall to widen the moat and punish your competitors, not just buy a nicer corporate jet.
Absolutely.
To wrap up this entire look at their operational resilience, I have to share the helium story from the earnings call, because it's the perfect microcosm of everything we've talked about today.
It was a very telling anecdote about supply chain agility.
So the retail industry is currently facing a massive global helium shortage. The commodity is tight everywhere. Hospitals, tech manufacturing, everyone is scrambling for it.
Right.
And Dollar Tree happens to be one of the largest buyers of helium in the world because of their massive foundational balloon business.
Balloons are huge for them.
Mylar balloons are a huge traffic driver for them around Valentine's Day, Mother's Day, and graduations. So what happens to a discount retailer when a key commodity completely runs dry?
A rigid, lesser operator would just put up a handwritten sign on the door saying, sorry, out of stock, lose the sale, and blame the macro environment.
Exactly. But Dollar Tree used their massive scale to secure whatever helium allocation they could, and then they seamlessly pivoted. They substituted stick balloons, which are visually identical Mylar balloons, but filled with regular ambient air and mounted on plastic sticks to capture the consumer demand.
Brilliant.
The CEO literally talked about throwing a 15th birthday party for his own son. He couldn't get enough helium, so he set up an entire table of air-filled stick balloons from his own store, and it looked fantastic.
The substitutability is the key takeaway there. They proved that if a highly constrained consumer comes into the store desperate to celebrate an occasion with a limited budget, Dollar Tree will have a solution that looks great and delivers unmatched value, regardless of global supply chain disruptions or commodity shortages.
So let's bring this all together. What we've seen in this deep dive is a company executing an absolute masterclass in a high-wire balancing act.
It really is.
They're aggressively raising prices, breaking their own foundational $1 barrier, and introducing multi-price items up to $5, all without alienating their core value identity.
Yep.
They are capturing high-income shoppers who are fleeing inflation at big box stores, while still serving the absolute essential last-minute needs of the low-income consumer. And behind the scenes, they are radically cleaning up the 42% of their physical store footprint that was dragging them down, unclogging their supply chain, and turning massive liabilities into operational efficiencies.
It is a profound structural transformation wrapped inside a very familiar traditional retail shell. I mean, the sheer corporate discipline required to pull off a multi-price expansion, a massive shrink reduction, a cultural store cleanup, and the launch of a targeted marketing arm all at the exact same time while navigating fuel spikes and tariff uncertainty is immense.
It really is. It's a completely different company than it was 5 years ago. But unpacking all of these brilliant operational moves leaves me with one final, lingering, provocative thought.
Let's hear it.
Something for you, the listener, to mull over long after this deep dive ends. We started this whole conversation by talking about the sacred contract of the dollar store, the promise of extreme, predictable value.
Right.
But as Dollar Tree effectively breaks the buck, as they introduce $5 hardware tools, as they start aggressively stocking the exact same name brand groceries like Spam and Rice-A-Roni that you find at a supermarket, and as they clean up and modernize their stores specifically to attract higher income suburban shoppers, are they quietly evolving into the very mass merchants like Target and Walmart that they originally set out to disrupt?
That is the million-dollar question.
If a dollar store isn't a dollar store anymore, but just a smaller, slightly cheaper neighborhood Target, what does the future of discount retail actually look like?